Hi friends, welcome back to our channel. In previous video, we have covered cost details. Now we are going to discuss about net realizable value. We need to understand net realizable value to complete the valuation of the inventory. Now you see what is net realizable value. Net realizable value of the inventory. So in inventory, we have few types of inventories. There is item by item, or only single inventory items, or there might be group of class of items. So in this we need to see item by item. Say suppose we have an rice packet store. So in rice packet store we have quality 1, quality 2, quality 3. In these cases, quality 1 rice packet as in a 100 rupees NRV per kg, quality 2 as 120, quality 3 as 130. This is NRV of the rice packet. So you cannot consolidate all three and value cost versus NRV. So while comparing NRV, you need to see by item by item you need to see. So this is the main important point in the NRV. You cannot confuse in the exams if they ask 2 to 3 rice packets or 2 to 3 inventory items. Say suppose item 1, item 2, item 3. Item 1 NRV is 120, item 2 NRV is 100, item 3 NRV is 130. And the cost for these items are 20, 130, 120, 140. In this situation, this is NRV and this is cost. Then we need to check whichever is lower value at NRV. Here we need to value at NRV. Here we need to value at NRV. Here we need to value at NRV. Whichever is lower. So another example, say example 4. The NRV is 150. The cost is 120. Example 5. The NRV is 170. The cost is 150. In this case, the cost of the inventory, whichever is lower is the formula. The cost of the inventory is the cost of the inventory is 150. How it determine that we'll let you know. But this cost, yesterday we learned how we determine the material cost and direct labor, indirect labor, and also overheads and administration staff, and also transport cost, packing cost. These all we already covered. This we calculate this, and if we have any number of items, actual production and normal production, we do that formula and divide these into the unit price. Now this we need to calculate now in our if selling. So concentrate on the next 5 minutes, you will understand the NRV. In NRV we need to calculate for two items. One is for finished goods, one is for work in progress, and another one is for raw material. Raw material you put aside for time being. Present we complete finished goods and work in progress. In finished goods, NRV formula is estimated selling price minus estimated selling expenses, which means, say in the previous example, category 1, quality 1, quality 2, quality 3 rice packets are there, right? In this you observe quality 1 you can able to sell at 150 rupees per kg after incurring expenses of 10 rupees. Quality 2 you are willing to sell 140 rupees after incurring 5 rupees of expenses. Quality 3 you are going to sell and in future in your newer market at 120 without having any expenses. So in this, if you see the formula, estimate quality 1, quality 2, quality 3, if you substitute this formula, quality 1 expenditure is 150, estimated selling price, cost 10. So the NRV of the quality 1 is 140. this is 135 and this is 120. See, these are the estimated selling price of the NRV of the particular products. So now you need to see how to evaluate that NRV on the reporting date. Say suppose in the same example you take these three items, right? In the same example, how we need to consider and all. So you have this based on the quantity of the stock. You substitute these formulas and calculate cost or NRV, whichever is lower, that would be their NRV, cost of the inventory. And again, if you see for work in progress, see work in progress is also inventory as per our estimate. So see this for this we need to see estimated selling price of the finished goods, same formula. Then estimated selling expenses of the finished goods. This, which means this is the finished goods. Previously we learned this. Say suppose 150 plus 10 in the quality 1 rice packet. So result 140 will come. Okay, if it is a work in progress and not a finished goods, value calculating the work in progress of the uh, inventory of the quality. In that case, you need to see additionally estimated selling price, say estimated cost to complete the finished goods. So say suppose this is example of file. So this would be the 135 would be the your net realizable value for work in progress. I hope you understand the difference. What is the difference between finished goods and work in progress? I will explain clear. I mean one more time. See, this is the finished goods and this is the work in progress. So now we have to see estimated selling price of the finished goods for the say suppose item one. Well, 100 quantities in finished goods, 50 quantities in work in progress. Here estimated selling price of these 100 items and 50 items will need to calculate. If you see the installation, I will tell you. Estimated selling price of the both finished goods, same 100 item, only one item, same item, right? So for this 120, for this 120. Next, estimated selling expenses. So to sell this product I need to incur 10 product, and to sell this product I need to incur this one. So this is the estimated net realizable value for the item 1 inventory. So this is net realizable value for finished goods. Until this stage for both workings are same. See, the change is next estimated selling expenses or work in progress or cost to complete from semi finished product, I mean work in progress, to finished goods. Say suppose 20 rupees. This is also you need to remove while you calculating work in progress, because you need to you didn't incur these costs at this time, right? So that you need to less that reduce that cost in the work in progress while calculating the net realizable value. And then you know cost of the projects and you know net realizable values of the both these items. Then you can compare the what is net realizable value and what is cost, and you can see the you can see the valuation of the inventory. And in NRV, one more important point is there. Maybe actually two more important points are there. For first one I will complete. Say example, in balance sheet date, you have 5,000 stock. 5,000 stock. In this 5,000, there are three categories. You have an agreement. You have an agreement. You have an agreement with the party selling these products at 10 rupees each. And the second case, this is the balance sheet raising reporting date, right? On this reporting date, too, Date of approval of financial statements. Date of approval of say suppose example 30th June, and then this from 31st March to from 30th June, March to June, which is your audit period or whatever the between the audit to, and in that period agreement in that period you have sold at 11 rupees. Okay, here you agreed for 2000 quantity and you sold 1000 quantity after that, and then balance 2000 is in your stock till the reporting days, and it is still unsold, and these are still unsold, and expected selling price of this product is 15. So in this example how we need to calculate, in this you need to calculate not only item by item, because all these are one item only, all these 5000 goods are one finished goods only, but you have different categories here. In this kind of situations you need to calculate separately. I mean to say, first you need to calculate for 2000, and you need to calculate for 1000, and you need to calculate for balance 2000. This I will explain you. Say total 5000 stock is there, total 5000. In this you need to divide 2000 is for agreement, 1000 between sales, and 2000 is stock as on reporting date. Here the contract, what is the contract rate? 10 is the contract rate, and what is the sales between these? This is the 12, and unsold product expected price is 15. So these are the NRVs for this particular 2000, for this one, and cost, all these are one item, the cost would be 999. All these are examples. While I'm telling the problems, you will understand more about these numbers, but I'm just explaining how it would be if you face this kind of situations in the exams. So now whichever is lower, whichever is lower, whichever is lower, entire 5000 into 9 would be the your cost. Say suppose example, if you change this costs to another numbers, like see the cost of this item is 10, the cost of this item is 12, if this cost of this item is 13, then the question is how it would be calculated. Now see, these are different now, different cost and different selling prices are there, because there even though there are same items, you can you need to spend more 2 rupees on this to sell this product, so that's why this cost would be 12 lakhs. Now you need to calculate for first 2000 at both are same, so both are at 10 rupees, and second 1000 you need to calculate at NRV because the cost is more in this, and third case you need to calculate at cost because lower of this NRV or cost. So this is how we have to calculate the NRV. And one more important point in NRV is net realizable value. In one more important point is reversal of NRV. What do you mean by reversal of NRV? Reversal of NRV means if you are sitting in the year 1 and you reduced the cost of the inventory because the NRV is lower than the cost. In the next year, the NRV is revised, that means increased to some extent but not complete, or is increased to entire more than the cost, and how it would be account in your books, that I will explain it now. Say suppose, here we take one example. Let me know if you have any questions in the comment sections. Here is the example: year 1, year 2, year 3. In these cases, the cost of the each years, say suppose example 100, 100 on 3 years, then NRV of these products: year 1 90, year 2 95, year 3 110. While you taking the while you sitting in the year 1 in practical, you don't need to do financials for all 3 years at once, right? So just we are good by year. This we don't need to confirm, I mean confuse the cost formula for year 1. If you're talking about year 1, whichever is lower cost or net value, it is 90 is your closing inventory, but your cost is 100, the balance 10 rupees is written down. How it would be written down, I will tell you. This is the P&L. In opening stock, we have this 100 rupees is the cost, right? Now you came to closing stock. Say assume sales and purchase are as already adjusted. So the closing stock the for same 100, now it has 90. So the gross profit or loss is 10. This is how it adjusts in the P&L automatically. This 10 rupees. The written down 10 rupees here automatically adjust that. And then year 2. In year 2, the NRV is 95 and the cost is 100. So both cost or NRV, whichever is lower, that is 95. So the same adjustment will come for year 2 as well. But here the important point is previous year it was 90, now it was 95. Then how we need to do it? In this we need to return off balance 5 rupees. In the year 1, see, now in the year 1 is complete. Then in the year 2, the PN in the PNL account, the opening stock would be 90 only, but you have increased stock to 95 because cost on net is there. But you have increased this cost, so you get this. You have increased the NRV, but cost is same. Still, you return down your cost to 5 rupees. The balance 5 rupees increase between year 1 and year 2. That we need to reverse. That means this 5 to 5. The difference between 95 and 90. This is the other income in your P&L account, which means your consumption has reduced, right? So now you need to reduce your consumption. I hope you understand this too. Now you understand NRV also. Then we'll see the raw material. Raw material also value of the inventory as per our previous discussion. Now we need to check whether it is we has to revalue at cost or is replacement cost. It is not an finish. It is not an selling price. It is a replacement cost. Say suppose example one. Here they clearly say that if finished goods are selling at profit, no return down. If finished goods are selling at loss, return on raw material. It means, say suppose the cost of this particular using these raw materials, you can produce one finished goods A. See this raw material valuation will depend on cost of that A and NRV of A. Say suppose cost of that A is 10 rupees. NRA of that cost of that item is 10 rupees in both examples, and NRV at that is 10 and 12. Okay, so what is the finished goods valuation here? We have valued at NRV because whichever is lower. Here we have valued at cost. Whichever is lower, we need to apply. In this situation, how we need to account this raw material? In this raw material, what is the replacement cost? Say suppose the raw material value is 2 rupees. The cost of the raw material is 2 rupees. And the replacement cost is 1.5 rupees. In the case 1, in the case 1, you have valued at NRV because you are returning down the cost because of the reduction in the NRV of the finished good. It means you're in the finished goods sold at profit, not if the goods is sold at loss. Yeah, the finished goods is sold at loss. So you need to return down the raw materials. How we need to return down? Either cost or replacement cost, whichever is lower. Here the cost is 2 rupees. Here the cost is 2 rupees. Replacement cost is 1.5 rupees. So the replacement value, the lower of this will come. So raw material value is 1.5. In this situation, you have the finished goods is at selling at profit. If you are selling at profit, so uh, no need to return down no need to return down the raw material value. So your raw material value would be 2 or 1.5, whichever is 2 or 1.5. You don't need to calculate this because you are not selling return you are not selling finished goods at loss, so then you can directly take it as 2 rupees. While clearing the examples, I mean, while clearing the problems, while explaining the problems, you will understand these very clearly. Now, for conceptual understanding, for quick revision, I am telling these classes. So now, now understand the same example as given. Now just numbers are changed. The cost of the item is selling, and selling price is 90. So selling cost is 5 rupees. So you need to calculate NRV like this. So cost of the selling price and this expected sales. So expected NRV is 5 rupees. There would be loss of 15 rupees because cost or net realizable value whichever is lower. That is 85 is the uh, value of inventory. And in cost, well while you calculating the cost, you now you understand how to determine the number. In the determine there are 3 to 4 items. No, I mean, you might have not purchased all at once because say suppose item 1 you have purchased in 3 quantities, 3 times: month 1, month 2, month 3. In this you purchased 1000 items at 20, and you purchase in month 2 purchased items at 21. You purchase same 1000 items at 19, because you don't need to maintain same cost by your vendor, right? They will change based on the demand of the product and all. So all these cases we need to determine cost formula, specific identification or unique methods and all. Now item is same, item A, item is same, but you bought from different months and different days and different quantities also. In the example, for clear and for easy and calculations, I took the same quantities. These quantities will change maybe in different quantities also. And the selling price of this product, I mean NRV, after calculating all, the price of this product is uh, 19.5. The price, the NRV of this product is 19.5. The NRV of this product is 19.5. Now you need to calculate, either I need to compare these to these 19 items, or I need to compare these with this 21 price, or I need to compare with this. Which one is correct? See, you can't compare like this. Now you need to understand these methods. What is the method? In valuation method. Valuation method is, are you following FIFO method, or are you following weighted average method, or are you following LIFO method? First, I will explain these methods and I will explain how Ind As allow these methods or not. See, in the same example, what is FIFO? FIFO means first in, first out. This is the inventory valuation method. First in, first out means, say suppose in the previous example, you have got the value of the item are 3 quantities: 1000, month 1, month 2, month 3, 1000, 1000, 1000. In this, the total sales, I mean, in the valuation, in the closing stock, you have only 500 stock, but you bought 3000 and sold 2500 already, so balance 5000 is there. But how you need to first you sell these or you sell this, you don't know, because you in the month 4 we have sold 2500. All these three items are stored in one Godam and they sold this 2500. We don't know which order we have sell. In this case, while calculating FIFO method, first in first out means out of this 2500 sales, first we completed this 2000, balance completed from here. So balance 500 is available from month 3 sales. So the month 3 sale cost is 19 and the NRV of this 19.5. So whichever is lower, 19, 500 into 19 is the answer if you follow FIFO method. If you follow weighted average method, you need to calculate weighted average of this cost. Say suppose this 20,000, 21,000, 19,000, 20k plus 21 plus 19 total 30k divided by 3,000 and 10 or not 1 second. The weighted average is coming around 20. Now you see cost or NRV whichever is lower. So NRV is lower then. So that 500 stock into 19.5. So if you follow this weighted average cost of these two, 21, 21 plus 19 plus 20. The weighted average cost is coming to 20. So now you need to calculate 20 or 19.5 whichever is lower. And then LIFO method is not allowed, but you need to see what is the method just for understanding. Not allowed in Indian standards, but it was allowed in international standards. Of course, international standards is not in our syllabus, and in differences also not in our syllabus. Just telling for IT professionals, for CA professionals who are already completed CA and just listening these classes for understanding purpose. So now this LIFO method is last in first out means first you sell this and you sell this balance if any you sell from this. So out of your 2000 sales, you both month 3 and month 2 you have sold, balance 5000 sold from here. So 500 available from month 1. The month 1 sales are 20 and the NRV is 19.5. So the cost or NRV whichever is lower, at 19.5 you need to at 19.5 you need to value the inventory. This is the core concept of the NRV. I hope I have covered all concepts of NRV and net realizable value and realization. One more concept is there while you calculate. All these are basic concepts. Until now, you can able to explain whatever you can. You can able to read simple. If you instead of wants to ask a simple problems, these are the concept. But if institute wants to give the tough problems, there would be one concept for this also. And then if you miss that concept, you will completely lose the marks from the inventory. Or 5 or 6 marks will come from inventory in general, so that you may lose if you miss the complicated problems in inventory. Now there are two more concepts in this inventory. One is deferred payment concept and second one is joint products and byproducts. First I will complete deferred payment process. Say suppose you have purchased. What is deferred payment concept means? In this, if you buy the goods at 100 rupees but you don't need to pay that 100 rupees immediately, you pay that 100 rupees after 7 months or after 6 months, same 100 rupees to the vendor. They give the credit period. See, in business, they don't anyone, no one will give for free. So the intention of this clause is like there might be hidden interest cost, the extra payment or what is your that now, that would be the interest expenditure is the included in the deferred tax model. In that, institute wants to, I mean, standard wants to eliminate that interest cost and value inventory correctly and balance the extra payment should be accounted in the inventory, not in the inventory, and the interest expenditure. Now you see condition 1, condition 2. In condition 1, if you give the payment today, I mean immediately, your cost is 1 lakh. If you pay the payment after 3 months, your cost is 1,10,000. These are the conditions. You selected this. If you selected this payment immediately, this concept will not come. But if you if you select this, if you select this concept will come. This concept will not come. I will explain. Today you go to the bank, took 1 lakh loan and bought these products from vendor at 1 lakh, which means what you did, you took the option 1. So this is your cost of inventory is 1 lakh. But after 3 months, bank you want to repay this loan to bank. Bank will take it as only 1 lakh or will charge interest. Will charge interest. So 5,000 or 10,000. What are the bank rate are there that you have paid interest? Or say suppose example 6,000 is your interest. So you take 1 lakh plus that 6,000 interest. So 1 lakh 6,000 you paid to bank. This is a clear case. Now you go to second case now. If you go to second case, in this second case, you didn't went to bank. You directly go to the partner. I said, I will pay this in 3 months time. He said, give this option. If you want to pay this in 3 months time, you need to pay me 1,10,000 after 3 months. Taking the loan from banks is not easy because vendor knows, right? Vendor can give stock and he will wait for some period so that I can get that stock without any bank processor. If for taking this 1 lakh loan from bank, we need to wait 1 week minimum, or lot of civils and everything. Complications are included and lots of time involved in it there. So they don't want to kill this time. So they took this option and take that cost for 1,10,000, take that goods for 1,10,000 and repay that 1,10,000 in after 3 months. In this case, if you see what is this 10,000 extra 10,000 for, means this extra 10,000 is hidden interest. This interest collected from us by that vendor for giving this time from 0 period to 3 months period. So this is called interest. Now how we need to calculate in this, if you know aware of these conditions, if you buy today we can able to get this 100, and if you 1 lakh, if you buy after 3 months, I mean if you pay after 3 months, we need to pay that 1,10,000. In these situations we need to calculate interest separately. Don't worry, all these instructions and all these details will be given in the question unless we don't know. In practical days, in practical in industry, you know how they are valuing and how they are financing funds and all. But in question, in exams, in the questions they will give all details. You just need to do the calculation and remember of these concepts clearly. Say suppose inventory, cost of inventory, your accounting entry would be cost of inventory 1 lakh, interest expenses Interest expenditure also you can't directly enter like this. You need to enter month on month, yeah, year on year, month one, month two, month three. Say suppose 1 lakh to raw material debit to sundry creditors payable to the party, 1 lakh, 1 lakh. And then in month 2, interest expenditure 1000 to creditor payables 1000. Like this, you have to pass until you repay. Then the 10,000 will come. All these expenditures. Now you need to pass that entry. Interest payable 100. When I mean 10,000. Vendor sundry creditors repayable 1 lakh to bank 1 lakh 10,000. This is how you need to enter these entries, and I will explain this clearly after while solving. In the next video I will solve the inventory problems or practical problems, what is important in the exams point of view. There you will understand more details. Now you got this right, NRV and net realizable value, and also deferred payment concept also now we completed. Now this deferred payment concept is everything same for every standard. The all standards related to asset and whatever it is, same for everything. So in PPA also it will come. So you will understand there also. The concept is same. What is the interest hidden in this? Here I have taken three months example. If you take that 2 to 3 years example in PPE, there would be more costs like 1 crore machinery, 3 crores machinery will happen. These will not repay in 3 months or 4 months. So it will take years. If you take that years, you need to calculate present value. That I will explain in PPE. But the same concept is there. In inventory generally happens in within 1 year. No present value concept will come as per my assumptions. But if you in the problem, if they give present value and the interest rate, you have to calculate. That I will explain in the problem. In generally in inventories it won't come. Actually it come in where it come in the PPE, just for logic purpose. I say I can do anything, it can give, but I just informing you the logic behind this deferred payments. Generally inventories are in within 1 year short periods only, right? I didn't calculate the present values. Now the joint products and byproducts, this is the most important concept in the inventory. All this generic discussion till now we have taken the conceptual understanding is direct way. Now there is a giant product and byproducts. What is giant product? Giant product is called, you have to produce two products at once. Say suppose item A, item B will come directly. These are giant products. For this you have to use same raw material. I mean the combination of raw materials and overhead process, everything is so. After processing all this production process, you will get two items, item A, item B. All this production process will create two items, item A, item B. Accordingly the after incurring production raw material cost, overheads, direct labor, indirect labor, everything, after incurring all this, you will get two products in the same production process. This is called giant product. Along with this giant product, one byproduct it also will come. This will come in 9,000. For your expectation is 10,000 normal capacity, and this comes for 8,000 production. So the with these abnormal losses, balance abnormal losses, because the expectation is 10,000 each, right? With this some materials is wasted in the production process. By that, if you spend some more costs in it, you will get byproduct. So byproduct is different from the accounting standard point, from India's point of view, and giant products are a different understanding from India's perspective. See here, you see, if you observe, giant product is the same item 1, item 2 inventory. A and B are two separate inventories, just the production process is same, so there are common cost to incur, get this expense, that is called joint cost. If you have joint cost, you need to allocate the joint cost into sales ratio of A and B. Say suppose A 9,000 units and B 8,000 units. You sold this for 100 rupees, you sold this for 50 rupees, and the ratio and everything, you need to calculate the ratios here. 9,000 multiplied by 9,000 multiplied by 100, the sales value is 9 lakhs. 8,000 multiplied by 50, the sales value is 4 lakhs. If you calculate the ratios, if you calculate the ratios, 1 second, this is 70% nearby and this is 30%. In this, to produce this giant A and B, you have incurred 2 lakhs rupees giant cost. So you need to calculate item wise cost, right? So now A and B, 70% is for A, 1,40,000 is for A, and balance 60,000 is for B. And then you need to calculate item by item too. I mean each item. 9,000 goods, 8,000 goods. Then you will get 15.55 cost of each item of A and 7.5 cost of each item of B. This is how you calculate joint cost while you have joint products in the production process. And then one byproduct has introduced, I mean one byproduct also will come in these situations. Generally in the production process there are lots of wastage will come, so that byproducts also, I mean those costs also will, if amount is immaterial, it must be measured at, say suppose if the byproduct C is immaterial, you know, right? Immaterial, the value of immaterial means that which is not material. What is material means, which that amount or which that portion or which that concept or which that thing, the what is happening for the C, the financial leaders will not affect their decision making while considering this value. So the volume of this portion or value of this portion is immaterial, which means the financial readers will not, the financial leaders decision will not affect by these amounts, is called immaterial. So if it is immaterial, you need to calculate an NRV means expected selling price of this product C, by product C, and their estimated selling expenses to buy. Say suppose in, if you incur expected selling price of this product C is 20 rupees, to sell that item as 20 rupees from this stage, you need to incur 2 rupees cost. So the expected NRV is 20 minus 2 rupees, so 18 rupees is your expected selling price of this, I mean NRV of this byproduct. And this cost, if it is immaterial, the cost of this cost, the cost of this byproduct is how we need to show that. Here the A and B, the total cost is 2 lakhs for this in our previous example, right? So say in the C we got 1000 items and the NR 20 minus 2 is, say suppose 5 is your net realizable value, and 1 we need to incur those costs. The 4 is our net expected NRV of this byproduct. So this 1000 items, if you sell at for this 4000, you don't need to show this in the inventory. You can reduce, you not can, you have to reduce this 4000 from this cost, and this 1,96,000 is your net by joint cost. So this is how the standard telling. So by selling these giant, by selling these byproducts, if you are getting any profits, no, that you have to include, that you have to exclude from here. So say suppose by selling this product, if you get profit of these 4000, you have sold in the market 5000. There is the expected NRV, right? The expected NRV. So you can sell or more or less. So the expected NRV is for valuation of the giant and byproducts or giant cost. But if you sell that, say suppose you have valued that byproduct at 4000, and you remove this from your giant cost. Now after 2 months, you sold that same byproduct C for 6000 rupees. So you have this profit of 2000. You don't need to reduce this profit again a year. So you already reduced this cost, now that is closed there. So this 2000 profit is irrelevant for calculating inventory. This you have to understand. In institute material we got one problem on this, so that's why I'm highlighting this profit point for the byproduct. So now today we have covered entire NRV, and how there are different types of NRVs, item wise and class wise and number wise, and the methods of the cost you already done, FIFO, LIFO, and raw materials. And also you have listen work in progress and how we calculate, and also you have listen raw materials and byproducts and giant payment deferred payment method. This we completed. By this we have completed 90% of the Ind As 2. Balance 10%. There are the not in IPC syllabus, not in final syllabus. In concepts, in actual standard it was there. That I will tell disclosures and all tomorrow class, and I will solve few problems of it, so that you can easily understand. By this video I want to tell one thing to the students: you have to practice thoroughly if you want to clear the exams fastly. So listen these classes and go through your notes, and by this you don't need to, by listening these classes you don't need to read entire standard. But now you can directly solve the problems as well, but you can read the standard ones if you want. But by listening this also you can able to solve. Tomorrow I will solve the problems. Okay, please subscribe if you have any questions. Thank you.